Got it.
Morning. Are we looking good?
Yes.
Okay, great. All right. Good morning, everybody, and thank you for attending our second session of training. And we need to get rolling, so everybody, I think, knows everybody. Carl, take it away.
Okay, thanks, Bernie. Again, it's good to see everyone. Thank you for everyone who this is session 2 for. And if you missed session 1 last week, it has been recorded. So if you haven't already watched section 1, please do. And today's stuff will make more sense if you've already had session 1, of course. We're going to start where we left off. But first, a couple reminders. As Bernie mentioned, if you have a question or a comment as I'm presenting from the slideshow, feel free to tap it or type it into the chat function. Bernie will then be monitoring that, and he will interrupt or break in at the right time and moderate the questions. But let's use that as much as possible. That way we're not talking over. I want to figure out how to mute everybody. Bernie, do you know how I mute everyone?
Yeah, I think you can. Yeah.
We got to mute so everybody mute.
Just we could ask everybody to mute.
Yeah, I guess that might be the best thing. Everyone, please mute yourselves if you're not already muted. And that's especially important for people on the phone if you have a mute function on your phone too. That way we can hear only one person at a time. I'm going to open up share screen now and start our function. Okay, can everyone see the PowerPoint here? Bernie, is that viewable? Okay, very good. We'll go ahead and pick up where we left off. As you can see, we covered a lot of material last week. And before I started slide sharing, I did have this opened up to the right slide, but when I started slide sharing, it took it back to. But helpful for us to see this again, maybe as we review. Okay, here's where we left off. So last week, we talked about the ethics. We talked about the importance of donor confidentiality. We talked about how we're going to address ethical questions. And we talked about our policies and procedures around our interactions with donors so that we don't do any harm and that we do good in helping our fellow Rotarians, friends, and neighbors have the philanthropic impact that's right for them, using the gift source and asset type that's right for them, as we do our volunteer work as fundraisers for Rotary in your case, or professionally in my case. We also talked about how fundraising is like inviting a friend to a restaurant. We have to know what the restaurant offers as far as menu items go, and we have to know the palate and taste and preferences for food of our friend. And when we know those two things, then we can make a good restaurant recommendation to our friend. And when we make a good restaurant recommendation to our friend, everyone's happy and really thrilled about it, because obviously the friend gets to have the same food experience that we had, that they liked, and they liked the food, and they liked the ambiance, and they liked the location, and they liked the overall experience. And obviously we're happy because we've been able to share that joy with our friend. And we talked last week about how it's important to know the restaurant first. And that's what Rotary is in this analogy. We need to know the philanthropic work that Rotary does, the world-changing work to end polio, to work in our 6 areas of focus, to work through our peace centers, and also how we work with district grants and global grants to accomplish those philanthropic aims. We have to know what the donor can do philanthropically. That's kind of like knowing what the menu of the restaurant is. Then we can find friends who share those views, who like that food or who like that philanthropic work. Now we're going to talk kind of on the other side of that today, which is more about how our donors, how our friends might go about accomplishing their goals with Rotary. And this slide is one we're going to spend some time on. And we're going to spend time on it, not because I expect or even want all of you to become experts on the things that are bullet pointed here, but so that you will have a general working knowledge and awareness more than anything else of all the different offerings there are. Because just as we do a lot of different types of philanthropic impact work, you know, we have 6 areas of focus. We have polio, we have peace centers, and we do so much through our district grants. There's a lot of philanthropic opportunity there. We are also very sophisticated and very capable of handling complex gift types. So when a donor wants to make a gift type of an asset that's not simple and direct, Rotary is prepared to handle that type of gift. And sometimes donors don't know that we can do these different gift options. And when they learn that they can do these different gift options, they say, I can make the gift I've always wanted to make. I didn't know that. And I shared last week an illustration of a young woman that I worked with up in Virginia several years ago who didn't know that she could use her retirement assets to fund a charitable gift. And she was just so thrilled and happy to learn that she could do that. And she's put the Rotary Foundation as the beneficiary of her retirement plans. And as such, Rotary in the next generation is going to have a lot more resources than ever before because she learned that she could do that. And we talked about how every donor has linkage, interest, and ability in common. And we said linkage means knowing Rotary and the Rotary Foundation. Interest means a passion for the world-changing work we're doing. And ability means the financial capability to participate in that work with a major gift. What we're going to talk about now are different ways that ability can be manifest. We're not all going to make a gift in the same way because we own different assets and have different goals and different timelines to consider. We're at different stages of life, and we have different philanthropic and financial priorities and goals. So what we're going to walk through now are different ways that different donors might use to fund a gift. And from a Rotary perspective, all of these are equal. We are happy with whatever the donor decides is best for them. We don't push one of these over the other. It's really to the donor, what's your situation, what works best for you, and we'll make that happen. So going through this list, mainly again, not to make you an expert on it. So don't feel like, oh, I can't do this job because I didn't understand everything Carl just said on slide 47 of the slideshow. Don't feel like that at all. Just feel that this is really cool that Rotary has this many different giving options, and we have professional staff who can help a donor who we might identify decide if this is right for them. So first of all, cash. You know, we all say cash is king, and we are happy to accept gifts of cash. No doubt about it, cash funding of a gift is wonderful. And it's still, in many cases, the best way for everybody to fund their gift. So certainly we take gifts of cash, American currency and otherwise, you know, because we're an international organization. So if you have a donor who has currency in a foreign country, we're sophisticated enough to accept gifts from those countries. And I say that because we do have a lot of donors who have moved to the United States and might be in our world because they're living here now, but they also are from a foreign country and they might still have assets in the currency of their other country. And sometimes it makes more sense for them to use those assets. And Rotary is able to handle such gifts to the extent allowable by law. And that's helpful to some of our donors, especially donors who come from a country like India, where there's a restricted currency. We're able to accept gifts from places like that many other nonprofits just are not internationally focused enough to be able to do. So cash. The next type of gift that I'm going to go to is the gift of stock. And speaking again for American donors without giving tax, legal, or financial advice, we can say that people who own stock have a wonderful opportunity to use that stock for a charitable purpose under our tax code. We can give gifts of stock that's appreciated without having to pay a capital gains tax on that appreciated stock. The way that works is the donor transfers ownership of the stock directly to the Rotary Foundation. The Rotary Foundation then issues the donor a tax receipt for the fair market value that stock held on the day that it was traded. The donor then is able, when he files or she files his or her income tax, they then have a tax receipt for the fair market value of the stock. So they're able to take a tax deduction and benefit from the appreciation of the stock in the form of a tax receipt at the market value. Rotary then doesn't have to pay any tax on that stock income because it's a tax exempt organization, and can use 100% of that gift to the charitable purposes that the donor selected. The donor never had to pay a capital gains tax because the donor never realized a capital gain. The donor transferred ownership of an asset without realizing a gain personally. And so there's no long-term capital gains tax ever paid in that transaction by anybody, and the donor benefits from the tax receipt at the fair market value of the stock. So it's a great opportunity for a lot of donors to fund a gift. So for many donors, it's probably better to fund the gift that way than it is to use cash. And when you fund a gift that way, you could then take your cash that you would have given otherwise and rebuy your stock and reset your basis and start over if you still wanted to own the stock. Or you could do something else with the cash and diversify your portfolio. That's all up to the donor. But we are prepared to accept gifts of stock when this is the right choice for the donor. And often it is. And so a lot of what we'll be wanting to do in this effort is letting donors know that this is a possible funding vehicle for them, and that they can talk with me about the details of that. And certainly they need to talk to their own financial advisors and professionals to find out what might be right for them. But Rotary is prepared to receive. We can receive anything that's publicly traded on any market. We can even receive mutual funds, which can be a little trickier, but we're prepared to do that. Closely held stock, we can receive if there's a buyer waiting in the wings. So if you have somebody who has something closely held and they don't have a market for it, we probably can't take it. We don't really have an interest in owning 50% of the barber shop or whatever it is. But if there's a buyer waiting in the wings who would buy it from us, then we could probably figure out some way to make that good. Where we get into the closely held stock a lot of times is when someone is selling their business. So if you know someone who is selling a business, sometimes what we can do is make a charitable gift a portion of the business transaction. Donors will sometimes have significant tax liability on the sale of a business. And what they'll do is they will figure out with their advisors the amount of their tax liability and the percentage of the shares of the business that would offset that tax liability as a charitable gift, and they will give that percentage of shares to the charity. The charity will then sell that percentage of shares directly to the buyer of the business who bought the rest of the shares. The end result being the business transfers ownership to the person who wanted to own it. The donor, seller of the business, is rid of the business, has cash and a charitable gift made that offsets their tax liability on the business sale, and the foundation gets more money to do charitable good with. So we can do that stuff. Most nonprofits are too small to handle that kind of transaction, but Rotary is sophisticated enough that with our good staff, my colleagues who are much smarter than me working up in Evanston, they can handle that stuff. So just know on the radar screen, if you're talking to a donor who says, yeah, I'm fixing to sell my business, say, talk to the Rotary Foundation about maybe making a charitable gift as part of that business transaction. It might work. An IRA rollover gift is a gift source that we need to be aware of because our demographic in Rotary benefits from this greatly. Donors who are over aged 70 and a half, who have a traditional IRA, can, instead of taking a distribution from the IRA, make a charitable, it's called a QCD, a qualified charitable distribution, from their IRA directly to the charity, instead of taking the distribution themselves. The reason for that is tax savings. So if you have a normal situation, you take the distribution from your IRA, you pay tax on it. You then have the money to do with as you please. If instead of doing that, you give money directly from the IRA to the charity, you can do up to $100,000 per year this way. That counts against your required minimum distribution, if you have to take a required minimum distribution, it counts against it, or it can take the place of it, assuming your RMD is less than $100,000. The money then comes right out of the IRA like it would have anyway, and it goes to charity. You don't receive a tax receipt, take it off of your taxes when you file taxes. However, you never had to pay tax on the money at all to begin with, which is actually more beneficial for donors who do not itemize their return. And since tax reform happened a year or two ago, fewer people are itemizing their returns because our standard deduction has been raised so high. And so you might have a donor who's retired, has to take their distributions from their IRA, but doesn't file long form taxes, so doesn't really benefit from a tax receipt. But if they give money from their IRA to charity, they still have a tax savings because that's money they never even have to take as income at all. So therefore, no tax is paid. And it's better, generally speaking, to not have the income at all rather than to have to do an offsetting deduction for it anyway. So this is really a great way to give for people who are over age 70 and a half and have an IRA. Where this gets a little confusing right now is as part of the CARES Act, which was a tax reform act passed in response to the coronavirus a few months ago. Donors who are aged 70 and a half no longer have to take a required minimum distribution this year. However, they still can take a distribution if they want to, and many people who are retired will because that's their retirement income. And so donors who don't have to take a required minimum distribution and who don't want the money to leave the account, this might not be a good year for them to fund with this giving strategy. But donors who are going to take a deduction anyway, or take a distribution anyway, this still makes sense. Additionally, donors who are not filing long form might find that this is still a good way to give. And again, we don't ever give legal tax or financial advice, but this is something that we should be aware of because it's the world in which our donors are working. And we should be able to make sure that our donors talk to their own advisors so that they are making the right choices and know that the choice that was right 12 months ago might not be the choice that's right today because our rules have changed in the last couple of months in response to the coronavirus relief package that was passed. Now I'm going to skip back up to the second option up there called pledge. And someday I'm going to rearrange this slide deck and put pledge down where it should be. The reason I skipped over it is because any of the things I just described can be used to fund a pledge. Pledge is one of those words that has a lot of different meanings. If I hear my church say make a pledge, that's different than when I hear my radio station say make a pledge. And that's different than when I stand up at the beginning of the Rotary meeting and say the pledge. And that's different than what I'm using the word pledge to mean right now. So in the context of Rotary Foundation, pledge has a very narrow definition. It means a single gift of $10,000 or more paid over a period of 3 or fewer years. So what we can do with the pledge is say, I want to give $10,000 total. I want to give $3,333.34 today. In 12 months, I want to give the same amount. And 12 months from that date, I want to give the same amount so that in 3 years, my total gift will be $10,000. That's what we call a pledge. Now, the donor can fund their pledge with cash. They can fund it with stock, or they can fund it with a rollover from their IRA. So we don't have to have the same funding source each year on the pledge. This year, it might make sense for me to give cash. But next year, my stock portfolio did really well. So it makes sense for me to give stock. And in the third year, I'm finally aged 70 and a half, and it makes sense for me to fund it from my IRA. So how the pledge gets funded can change. So one of the benefits of the pledge is it preserves the flexibility for the donor to fund with whatever asset makes the most sense in that particular year, which might change. What cannot change is the designation. What I mean by that is if I decide that my gift is going to go to polio, I have to put every one of those pledge payments to polio. I can't say polio this year, annual fund next year, endowment fund the year after. I can't divide it between polio and annual fund. I can't divide it between endowment fund and polio or anything. I have to pick one designation and keep the entire pledge to that singular designation. That's where we run into a lot of confusion, and you can understand why people get confused over that, because it's okay to change the funding source. It's not okay to change the designation. This is an area where us knowing this as a team can help us have good conversations with our prospects who might want to use this gift type. But again, please don't feel like you need to memorize this or become an expert on it. You now know it exists, and you can feel free to put a prospect in touch with me at any time to get a specific question clarified. It's always better to say, that's a great question. I don't know the answer. Let me put you in touch with Carl, than it is to try to remember or guess wrong. So know that this exists and know that it's an opportunity. The next two types of gifts that I'm going to talk about are life income agreements. Life income agreements are wonderful tools of philanthropy that we have available to us through the Rotary Foundation, and that if more Rotarians knew about them, more Rotarians would do them. They come in two flavors. In general, they're similar in this way. They both work as follows. The donor gives away an asset, usually cash. The donor then receives income for the rest of his or her life, or a period of years, depending on their selection. And at the termination of that period of either the donor's life or the period of years that the trust was set up for, the assets then get used for charitable work. So it's kind of one of these in-between things. It's neither fish nor fowl. It's not quite the same as an outright gift of cash, but it's really not like a bequest either. With a straightforward bequest in my will, I keep ownership of the money, and at my death, it goes to charity. And that's when the charitable work happens. Straightforward. With an outright gift of cash, I leave ownership of the money today, and charitable work starts today because the charity has it, doing charitable work. This splits the difference. Ownership of the asset transfers today, but charitable work doesn't begin until the death date of the donor or the term of years that the trust was established. Why would somebody want to do that? Well, in many cases, the donor needs or desires or wants to have income from their assets during their lifetime, but they don't need to own the asset. They just need to have the income that the asset is producing. So they can make a gift with a life income agreement, accomplish the charitable goal that they really want to do, and ensure that their legacy continues with a gift that will do philanthropic work after their life is over, and benefit tax-wise from a charitable gift today. There's no tax benefit today for making a bequest. I can change my will today and give everything I own to charity, but when it comes time to file my taxes, I can't take that as a deduction. However, if you do a life income agreement, you do get a tax deduction today, even though charitable work doesn't start until tomorrow, because ownership of the asset changed hands today. That's kind of the overall theme of how life income agreements work. The simplest of them is the charitable gift annuity. A charitable gift annuity is a simple contract between the donor and Rotary, whereby the donor becomes an annuitant of the Rotary Foundation, meaning that the Rotary Foundation has a legal obligation to pay the donor the terms of that contract every year. The charitable gift annuity can be done by any donor who is over aged 50 years, 50, and the minimum amount is $10,000. The amount of money that the donor will receive each year is based on the donor's age. So for instance, a donor who is aged 67 right now will receive about 4.8% on a charitable gift annuity. So the donor would give X number of dollars, and then 4.8% of that gift value, whatever that number would come out to be, would be paid to the donor every year as long as he's alive. Of that money that the donor receives, a portion of that is not subject to federal income tax. So the donor gets to have some of that income tax-free. Additionally, the donor gets a charitable tax receipt today for a portion of that gift value as well. So the donor gets an immediate tax deduction and benefit of tax-free income going forward. So you might see why a donor might choose to do that instead of simply making a bequest. The charitable gift annuity rates are dropping on 1 July in response to the lowered interest rate environment. They're going to go down between 0.3 and 0.5%. I closed on one yesterday with a donor in Virginia who wanted to do one to join the Arch Clump Society before the rates fell. I have one other donor who is in the process of deciding whether or not it's right for him now. And I had one other donor who looked at it and said, it's not right for me now. But please do know for your own selves, if you're interested in this, be in touch with me ASAP, because to lock in at the higher interest rates, we need to have the payment done by the end of this current month, which we're ticking our way through on the clock very quickly. The interest rates will still be competitive, but they won't be as good as they are now because we're in a falling interest rate, very low interest rate environment. What happens, how these interest rates get determined is that there's an independent charity called the American Council of Charitable Gift Annuities. They exist for the sole purpose of telling other nonprofits what responsible rates are for charitable gift annuities. And most nonprofits follow those recommendations, as does Rotary. And that council is famously slow to respond. They're very conservative in their approach because they're looking at long-term. They don't want to be reactionary. They want to make solid decisions for nonprofits and to protect donors. And so when an interest rate dynamic changes rapidly, the charitable gift annuity is usually about a quarter, 3 months behind the rest of the market. So when we have a sharp rise in them, we have a time period where it's not a great product competitively. And when we have a sharp decrease, we have a window of time where it's a really great product competitively. And as you all know, the interest rate, the plummeted as response to the coronavirus. And so we're in that closing of that fiscal quarter, that 3-month time where the charitable gift annuity rates are unusually high compared to other products in the market. So now is a good time for those. But they still will be competitive, just at a lower rate. The other form of a life income agreement requires the donor to have at least $100,000. So if we're not talking of a 6-figure gift, this one's not on the radar screen. But if we are talking a 6-figure gift, this becomes an option. Instead of just entering into a simple annuity contract with the Rotary Foundation, where the donor receives a set amount of money every year, totally not dependent on market fluctuations at all, just a set payment, good times or bad, the same amount with the charitable gift annuity, the donor can instead choose, with the gift of $100,000 or more, to do a charitable remainder trust. What happens here, the money stays in the trust and is invested by the trustee. The Rotary Foundation is happy to be the trustee of the trust if we are the only beneficiary. We are also happy not to be. We are totally agnostic as to whether or not we are trustee on a CRT. The trust generates earnings each year. And the first thing that happens is the charity gets a look at it and the donor gets paid. So the charity receives no income. Charity gets to look at it, see what it's doing. It doesn't get money from it. And the donor gets paid. When the trust was established, the donor determined what their payout percentage was going to be. So say the donor chose 5%. 5% of whatever the value is at that time gets paid to the donor. If the market was really good, the donor might get a lot of money because 5% of a big number is a lot. If the market was really bad, the donor might get 5% of a smaller number. It also does run the risk that it could be depleted over time because it is invested. So there's risk of depletion of the asset in the trust. Then at the termination of that trust, and this is the one that can be set up either for a period of years or a donor's lifetime, then whatever's left, the remainder, goes to charity. So we can do either one. And again, Rotary doesn't care which one the donor picks. It's what's right for the donor. And depending on the circumstances and what the donor is looking for and what assets the donor has, one of these tools might be better than the other. Rotary is happy to work with donors with either of these tools. And there's even more sub-flavors of these that go beyond the scope of this presentation, but in some situations might be better tools than even these, and we're prepared to do those as well. Life insurance is an asset that rarely makes a good charitable funding vehicle, but sometimes it does. It's kind of like it doesn't work unless it does. So life insurance can be used to fund a gift in two ways. Way number one is simple. You can make the charity the beneficiary of the policy at your death. Very simple to do. What happens there at your death, the insurance company, gets the death certificate. They say, yes, the donor has died, pay out the contract. Oh, the Rotary Foundation is the beneficiary of X dollars or X percent. Send the check and you're done. That's that. So why wouldn't that be a great way to fund a bequest? It's simple. The answer has to do with the way we tax life insurance as a country. Generally speaking, anyone can receive life insurance payment without having to pay tax on it. So for instance, if someone who is in my beneficiary policy, when I die, they get that check from State Farm, they don't have to pay income tax on that because it's not considered income to them. It's considered loss replacement. It's considered that they got that money because they lost me. And so our tax code doesn't view it as income. And so other assets that I might have might go to people and they'd have to pay income tax on receiving those. So it makes sense oftentimes to use our life insurance to give to our non-charitable heirs, our children, our friends, our family members, the other human beings in our life that we care about and want to provide for. Insurance is great for them because they can receive that cash without having tax liability in most cases. The charity wouldn't have a tax liability on the other assets. So when we have the beneficiary designation on a retirement account, if that goes to another person, they have to pay tax on it. If that goes to charity, the charity doesn't have to pay tax. And so rather than putting the beneficiary designation for charity on a life insurance product, it's probably better to put the non-charitable heirs as the beneficiary of that and use our other assets that would be taxable to those people to fund our charitable gift. But sometimes it does make sense. It makes sense to do that when everything's going to charity. I'm giving my entire estate to charity. And when I'm doing that, it doesn't matter what the taxable situation is because charity's getting all of it. So yes, please take the life insurance and do good in the world with it. Great time to use life insurance then. The other time it makes sense to use life insurance is when I have a charitable goal that is so big that the only asset that I own that's big enough to accomplish it is my life insurance policy. So I worked with a donor several years ago. Ann knows him. We met together. In fact, Ann and I met together with Carlos in Clemens, North Carolina, several years back. And we worked together on this gift. And Carlos wanted to fund a gift that was so big to endow a global grant for his district to do work in his home country of Nicaragua, that the asset that he used to fund that was his life insurance policy. Because of all the assets he had, that was the one that was big enough to have this really big philanthropic impact he wanted to have. So in that case, his desire to have the philanthropic impact was so great that he used this asset that he had to do it because that was the asset, that was the round peg into the round hole in that case. So there are times when insurance gifts are right, but there are most of the time, they're actually probably better assets that the donor might have. The other way that insurance can be given is to transfer ownership of an insurance policy to the Rotary Foundation or to charity. This has a great benefit for donors. But in our context, the Rotary Foundation's gift acceptance policy only allows donors to do this who are within 10 years of their actuarially predicted death dates. The reason for this is Rotary has done a cost-benefit analysis and determined internally that the cost and liability of owning, monitoring, and managing many different life insurance policies outweighs the financial reward on them unless the donor is within 10 years of his or her actuarially predicted date of death. In other words, we don't want a bunch of 20-year-olds giving us life insurance policies that we have to spend the next 70 years dedicating staff time to managing. So if the donor is, say, over aged 80 and has significant value life insurance, this might be a good gift source for them to give ownership of the policy. But that's pretty rare. I rarely work with someone of that age who still has a life insurance policy in force that's of significant enough value that this gift type makes sense. But some do. And if you do run across someone in that age range, say over aged 80, who does own life insurance outright and would like to make a gift of it, this can benefit. The donor receives a tax deduction for the value of the life insurance policy, not the death benefit, but the value that it holds at the time, the cash surrender value. And at death, the Rotary Foundation will get the death benefit value to do charitable good with. And if the donor is still making payments on the policy, those payments are tax deductible when the donor makes his payments. But again, I don't know of too many people over aged 80 who are still making payments on their life policy. So the odds of us running into people like this are pretty slim. But the only reason I even mention that is because if you get into a gift conversation about making a charitable gift of life insurance, donors are often thinking that you mean giving it to them because that is such a common way outside of Rotary to do charitable giving. And we're usually talking about beneficiary designation. And so we want to be clear when we're talking with the donor what we actually mean so that we're all, singing from the same hymnal. Bequests are a wonderful way to accomplish the biggest philanthropic goal we will ever have. No matter how wealthy we are, we can always do even more with the bequest than we can do with an outright gift. Unless we want to give all our money away and go live in a cardboard box under the I-10 overpass, we can afford to do more with the bequest than we can with our cash giving during our lifetime. And that's why you will see the most generous donors of all income and wealth levels using bequests as one of their multiple tools of philanthropy. Some do it through, I said, the life income agreement that I described. Others say, I will retain ownership of the asset as well. And at my death, those assets will pass to Rotary. There are lots of ways to fund bequests. And every Rotarian, every donor needs to talk to his or her own lawyer, own advisors, accountants, etc., to figure out what's best for them. We can never tell a donor, this is how you should fund your bequest. We have seen over the years at Rotary, well-intentioned Rotarians accidentally practicing law. We want to avoid that. We never, ever want to give a donor a codicil that we have written and say, this is your estate plan modification tool. We never want to tell a donor how to modify their estate plans. We always want to tell them what they can do, invite them into conversation with the right people, encourage them to talk to their own advisors, whoever they choose, and make the decision that's best for them. If you've ever received an email from me, you will know that on the bottom of my email, it says, nothing in this email is tax, legal, or financial advice. Please talk to your own advisor to determine what gift is right for you. I send that out even if you just sent me an email to say, Carl, what's the weather like in Raleigh today? You will see that. I'll say it's raining and warm, and you will see that on the bottom of the email. We have accidentally in our Rotary culture, sometimes in an attempt to help donors, asked a member of the club who may be even an attorney to draft a codicil, and then we hand it out to people and say, please sign this, put it in your estate plans. That has never been done officially by the Rotary Foundation. Those actions have never been officially approved. They are not good. We don't want to be practitioners of law. Even if we are attorneys, we are not that donor's attorney. And so we don't want to accidentally cross any lines here, getting back to our ethical stuff we talked about in session 1. So what we can do is give donors some great information that they can then take to their advisors and act on. One of that great pieces of information that we'll want to share is that donors might consider funding a bequest to Rotary with a beneficiary designation on a retirement account. We could do an entire session on using retirement account assets for charity. They're probably, for most donors, the best asset we own for charitable impact. I already talked about how if we're over age 70 and a half, we can use our retirement assets in an IRA to accomplish a charitable goal with a qualified rollover. If we're under age 70 and a half, we can still use those assets in a very tax-effective way for a bequest. So for instance, I'll use myself as an example. I am in my 40s, still saving for retirement, a long way from it. I look forward to many years working here at Rotary before I retire, but I'm saving for retirement. Every paycheck, have deduction taken out, put in my retirement savings accounts. Look at those occasionally, but by and large, I ignore them. Set the investment trajectory for where I'm comfortable, have it diversified to the level I want, and I set it and forget it. And, glance at it occasionally, but I don't look at it daily because I'm years from needing to call upon those assets. But something else that I can do now is to put charity as the beneficiary of those accounts, at least in part, in my case in full, because I have no children or heirs, but even people who do have family in a partial designation can work. So that at the death of the donor, those assets pass directly to charity. The reason this makes such a powerful funding vehicle is, one, most of us have it. Even if we're younger, we're still saving for our retirement. So we might not be at a place in our life where we have a lot of cash in the bank and other assets, but we're saving for retirement. So we have a bulk of money over here in a qualified plan sitting there. Again, we're ignoring it because we're building it. Then there's the tax savings. That money's never been taxed. Money's been put in that account by me, tax-free. Sometimes employers match it, put money in there again, tax-free. The markets grow as it's invested. They have gains in those accounts. Again, never been taxed. If nothing else happens at our death, those pass into our estate as taxable income. The estate then has to pay income taxes if we'd earned all of that money in one calendar year. That's going to be a heavy tax burden on both local and federal tax returns. Or we pass it to a non-charitable heir, and the non-charitable heir has to pay tax on it when they take it out in the form of distributions. Or we give it to charity, and no tax ever gets paid. Ever. It's the only way that I know legally to earn money, invest money, grow money, and have money and spend money without ever incurring any sort of tax liability on it, which makes it so powerful. If you assume a third would go to taxes, that allows you to have a third more philanthropic impact by funding with this charitable vehicle. So what happens if we put the charity in, at our death, the money goes directly from the qualified retirement plan to charity. No tax is ever paid. Charitable work done, estate simple. It doesn't come into the estate at all as income. It gets spent on the charitable purpose I wanted, have the legacy I want, do the charitable good I care about. At Rotary, created the named fund, so it's done in my name. That's a win-win-win. So what I'll often talk about with younger donors is fund a bequest like that today. And then when you get to age 70 and a half and start taking your distributions, reassess your financial situation at that time. And you might find then that you can put that bequest into effect. So put the bequest in now. And then when you're age 70 and a half and you say, wow, I'm retired, I'm able to, do what I want to do in retirement, I can even accomplish a philanthropic goal with the qualified rollover distribution. And then you can fund that bequest in your lifetime and put those assets to work during your lifetime and have a tax advantage. I'll work with donors who are maybe close to age 70 and a half. Maybe they're, say, 68, 69. They want to make the gift today, but it just doesn't make sense tax-wise to give it today. They can't do that rollover distribution because they're not age 70 and a half. Just put it in as a bequest today. That way you know it's done. No matter what happens, the gift gets made. Put it in as a bequest today, and then at age 70 and a half, go ahead and fund it. And this is a great tool for younger donors to still have a tax-saving way to give. And so this is something that we'll run across a lot. I had a phone call yesterday from a donor up in Virginia who one of the people like you who I trained up there had this conversation with him. And he called me and all he said was he introduced himself and he told me who he was working with. And he said, they said something about a bequest and I needed to call you because there's cool ways to fund it. And I said, yep, that's all that the volunteer needed to tell him. And then we talked and this is exactly what he decided to do. And I'm working on the paperwork with him right now on this. So again, this is something to be aware of. The final point here, well, second to final, the final point that actually has a label on it that's not other is a donor advised fund. The donor advised fund itself does not do a whole lot for charitable impact. It's really just a tool of getting money from point A to point B. It's a great tool for donors who want to separate the date that they get their tax receipt from the date that their charitable work starts. Why would you want to have two different dates on those points? Well, the first one is related to tax receivability. Maybe I had a lot of income this year, and so I want to fund a charitable gift this year when I get the tax receipt. But I haven't quite made up my mind about what charity I want to support yet. Or I know that the roof at the church is leaking. I know that the vestry is going to be coming to me asking me for a capital campaign pledge in the next year or so when they finally get that committee formed. They're going to do it. And I want to be able to give, but I need the tax receipt now. So I know that's coming at me, but I can't wait to give the charitable gift because I need the tax receipt in this year. Or I have a donor, for instance, who has younger children, high school age. He knows that as they grow older, they're going to have charitable interests. He's encouraging them to get to know the world and find out what things they're passionate about, but they don't know what they are yet. They're kids. He also knows they'll pick schools to go to. And when they go to those schools, there will be charitable opportunities to give to those colleges and universities, but he doesn't know what they're going to be yet. So he knows that because of his children, he's going to have some calls for charitable giving from his family in the next several years. He also has some really high income right now. And so he wants a charitable receipt today, but reserve the right to give that money to the charities he's going to care about tomorrow. So in those cases, the donor can give money to a donor advised fund. The donor advised fund issues a tax receipt today. The donor gets to take his charitable deduction today. And then later on, the donor directs the DAF, that's why it's called advise, the donor gives advice to the donor advised fund and says, please give X number of dollars to this particular charity. It's a great stepping stone to separate the date of charitable impact from the date of the tax receipt. Not every donor advised fund is created equal. Different charities manage donor advised funds for different purposes. The Rotary Foundation manages our donor advised funds for Rotarians to have an easy way to fund Rotary projects. We know that Rotary is complicated. We give to different things, all Rotary. If I have a donor advised fund with someone other than Rotary, and I say, please give $1,000 to the annual fund to satisfy my Paul Harris Society commitment this year. Please give $4,000 to the Polio Plus Fund for my participation in my club's Polio Plus effort. And please give $10,000 to my endowment fund. You are lucky if that non-Rotary DAF even gets $1 to the Rotary Foundation of Rotary International instead of sending it to the Rotary Foundation of the Rotary Club of Pittsburgh, PA, because that's what they found first when they Googled Rotary. We run into this with outside DAFs a lot. However, if we have a DAF with Rotary, our staff and our systems are set up to fund all of Rotary's stuff easily. And so if you have a donor who needs a DAF, and they give a lot to Rotary, which is probably who we're working with, having a DAF with Rotary is particularly helpful in those cases. The other thing is some DAFs are set up with the mission of the organization in mind. For instance, a community foundation may set up a donor advised fund and only give grants from that to charities that are in its own community. So you might have a community foundation in a particular county, and they only give grants from their DAFs to charities that are located in their own county. There's nothing wrong with that, but that might not be what a donor wants. And a donor to Rotary has the benefit that Rotary, as policy, makes any grant that the donor advises that's legal to do. We don't screen them. We don't say, oh, sorry, you want to give to that charity. We don't like that charity. We don't agree with that charity. We're not going to give to it. We don't exercise that level of editorial control that other donor advised funds might exercise. So if you have a donor who wants to preserve maximum flexibility as to what organizations get the benefit from their DAF, Rotary offers that as well. Full disclosure, where we're weaker, if you have a donor who really wants multiple investment options within their donor advised fund, we are not the right place. The commercial donor advised funds offered by places like Schwab and Vanguard do a much better job of offering lots of different investment options. You know, if you did a Vanguard donor advised fund, every investment product Vanguard offers is available to you. With Rotary, you will choose low risk, medium risk, or high risk, and thus ends your investment choices with your donor advised fund with Rotary and most community foundations too. So they're not all equal. When we have a donor who needs a DAF, the donor really needs to look down and see which DAF is right for me. And if the donor decides that Rotary has a DAF that's right for them, we're happy to work with them on that too. Now, we do not count gifts to a donor advised fund as a charitable gift to the Rotary Foundation for donor recognition. The reason for that is the donor can still give it to another charity instead of to the Rotary Foundation's programmatic work. So what we do count is if donor has money in a DAF that they then give to the Rotary Foundation's 3 principal funds, which we talked about, Polio Plus, Annual. So the donor would get recognition value when their money came out of their DAF to our programmatic work. Otherwise, you could have a donor give $250,000 to a DAF and then empty it out to the church, and they would get Arch Clump recognition, but the church got all the money. So you can see why we've made that policy as to when the recognition kicks in, even though it can be a little confusing. If you stop and think about why the decision was made, it makes a lot of sense. Another time that DAFs are really helpful are when people give to small charities but want to use depreciated stock. I keep going back to the example of my little church. We are a nice little Episcopal church here in suburban Raleigh. We do a lot of things really well. We do not handle gift processing well. You could not handle a gift of stock if we wanted to. We're just not that sophisticated. So if a donor wanted to give stock to a little charity like that, an easy way to do it is with a donor advised fund. The DAF can accept the gift of stock without problem. We put the stock in the DAF. We then benefit from the gift of appreciated stock in the ways I've already described. We then have the DAF write a check to the small charity. The small charity gets the check, puts it in their bank, everything's right in the world. And so donors who give to a lot of small charities but want to use complicated funding strategies that outstrip the abilities of those small charities to handle will find a DAF a great tool to do that as well. DAFs also allow for anonymity. When someone gives to a DAF, the DAF will give them the tax receipt. That means the DAF can then give the money to the charity with 100% anonymity. So the local charity doesn't even know who gave the money because they don't have to give a tax receipt. They don't need to know. You could give the money to the charity and say, please keep it anonymous, but the secretary who opens the mail still knows. And everybody on the board of directors who reads the financial books for audits still knows. You know, you're still gonna have some, they're not gonna publish it on their internet page, but you'll still have some people in your community who would know. And in some cases, that level of knowledge is too much for some donors, especially in really small towns where everybody knows everybody anyway. So donors in those cases might like to use a DAF from a big organization far away like Rotary And all the local nonprofit would know is that one of the 1.2 million members of Rotary somewhere in the world sent a gift. And that's a pretty good level of anonymity. Other. What I just said are our most common gift types, but they are not totally exclusive. We have donors who own really unique things, and sometimes they might be good gift funding assets, and at other times they're not, but we're happy to talk about it. Most commonly, we get into real estate. Real estate has to have a minimum value of $10,000 for us to consider it. There's a whole process to go through. It's not onerous. It starts with the donor filling out an inquiry form with us. It's a one-page form. Our gift admin will look at it. It takes care of really clear, obvious things. For instance, are there back taxes owed on it? Is it subject to litigation? Does it contain hazmat issues? Things like that that would be immediate disqualifiers from us being interested in ownership. If it passes that, then our gift admin gives the person the green light to get their own appraisal at their own cost from their own expert. They then take that, get that done, and submit the appraisal to us. That then gets looked at by our gift administration department. And if they decide at that point that it's worth doing, there's some other steps that they can take. They consider a market feasibility study to look at likelihood of liquidation quickly. And if it passes that, then Rotary can accept ownership of the real estate. Rotary will then sell the real estate, has no desire to own anything other than what we already own, and use the money from the sale for charitable good. So we do get into that occasionally. We do not accept automobiles unless it's a particularly valuable automobile, say more than $100,000, a collectible car or something. But generally, they didn't want my 10-year-old Ford Focus, for instance. We also can accept gifts of things like tangible personal property, such as precious metals. Sometimes art gets brought up. Art is rarely ever a good decision for Rotary. The way tax laws work, to get the maximum tax benefit from a gift like that, it has to be used as itself for charitable purposes instead of sold. So Rotary would want to sell it and get money. That gives the donor much of a less tax benefit than if it was given to an art charity that hung it on the wall and showed it. And so generally speaking, we're not a good candidate for that, but you never know, we might be in the right circumstance, so we can have the conversation. But we do have a very comprehensive gift acceptance policy, which can be found on our webpage, but it's probably beyond what any of you need to really dive into. But if you do have somebody who comes at you with a particularly unique gift, feel free to put them in touch and we can see if we can make it work. We will, and if it's not the right gift for us, we are very clear about that too, and are happy to encourage the donor to use the right asset. We're not trying to convince a donor to use the wrong asset. We just want to help donors use whatever asset might be right for them. This is our longest slide. This is the slide that is the most detailed and nuanced, and why I didn't want to get in. This is why we had a break point before we started today, and it's the most dense slide. And so now I'm going to pause. We'll see if we have any questions or comments about this, and then we'll move on to stuff that's a little less intense.
Carl, I think I could safely say that was pretty amazing. And I think you did. I think you set a new Zoom record for the most time on one slide. I was about an hour on that slide was pretty amazing. I didn't get any messages in the chat. I think people were pretty amazed at the detail that you went into. I guess I'm looking at chat now. I don't see anything. Is everybody pretty much overwhelmed? I'm guessing. Shake your head if you're overwhelmed. Lou Mello's he's not overwhelmed. So there you go. Okay, I guess
that's because of his Ohio State University background, Bernie. People from OSU never get overwhelmed. If they did, they could never play Michigan.
Ooh. Okay, we're going to keep this away from college football. Okay. Okay. Yeah. Paul, there's a comment here. We know who to call. And I think that's probably, looking at all this, I think that was the point that was made. We know who to call if there's questions. So, Ione, do you want to unmute and then ask your question?
I do. Yes, thanks, Bernie. I have a question on using the required minimum distributions and using a donor advised fund.
Oh, yeah.
Can you do an RMD directly to a DAF?
No, you can't.
Okay.
And you also cannot use it to pay a pledge. Or you can use it to, okay, so you cannot use a qualified minimum distribution into a donor advised fund. It has to go directly to the charity, and you cannot use donor advised fund assets to pay a pledge. So those are two little hiccups. The reason is the pledge is legally binding and you don't own the asset that's in the DAF. So you can't commit to that. The IRS is presently taking comments on that and might change their ruling on the use of DAFs as regards to pledge payments. So if you really feel passionate about that, please share your comment with the IRS and maybe they'll change their ruling. But as it stands
I'm sure
today,
they'll do it. I'm sure they'll do it if I call and talk with them about
that's
it.
right. That's right. Yeah.
Okay.
But as of this moment in time, you're right. The qualified distribution cannot go into a donor advised fund and assets in a DAF cannot be used to pay.
Okay.
Thank you for bringing that point.
Carl, just a procedural thing. If you do me a favor and click at the bottom, click on participants. There's one participant that has not muted themselves. And I think if you do that, you'll see them. It's a phone number. Somebody's in on a phone. Can you mute them? Can you mute that person?
I think I have to stop sharing the screen maybe. How do I find participants?
That bottom of the screen, just take your cursor, go to the bottom.
Yeah, my bottom of screen's all blank, probably because I'm screen sharing. Let me stop sharing and see if that, yep, that helped.
Okay.
All right.
There's somebody on a phone that I think we keep getting a little background noise. If you can mute them, that'd be great going forward.
You got it. That's done.
Okay. Okay. So
thank you.
I think slide 2.
Okay. Am I still screen sharing or not?
No.
Okay. Okay. Is that screen sharing now?
Yes, you're good.
Okay. All right. Great. So we have now found the donor using our linkage, interest, and ability that we talked about. We have found the charitable good that the donor wants to do that Rotary does that we've talked about. And the donor has, with their advisors and our conversations, figured out how they want to fund their gift. The gift is now almost done. We're tying the ribbons on it. But we're getting to one of the most important things of all, and that is the saying thank you. And our first slide, we talked about how stewardship is the most important part of the fundraising cycle, thanking our donors. And one of the ways that we do that at Rotary is through our formal recognition processes, which we have established with different levels of giving recognition in 2 different categories. So when a donor makes a gift that is irrevocable, outright gifts and life income agreements that I mentioned, they get major donor / Arch Clump Society recognition. When a donor makes a gift that is revocable, such as a bequest, funded any way that I mentioned, they get Bequest Society membership. And a donor who does both will get both kinds of recognition. This is really important because we recognize that people who make bequests need to be thanked and recognized just as much as people who make outright gifts. But it's a different type of gift. It's revocable. The donor needs to be able to make revocable gifts in order to have their maximum philanthropic impact. If you told me, Carl, you can only put Rotary in your will if you never ever change it, well, I couldn't put you in because I don't know what my life circumstances might be in 10, 20 years. I might need to change my will. So we need to have a way that allows donors to make a life commitment today from their estate plans that allows them the flexibility of changing that as their life circumstances change. But that's really not the same as somebody who's already made ownership change happen. So we want to recognize both gifts appropriate. And therefore we have Bequest Society for revocable gifts and Major Donor Arch Clump Society for irrevocable gifts. And so if we're thinking this is the gift, which kind of recognition does it get? The easiest way to answer that is, can the donor take it back? Can the donor change their minds? And if the donors can change their minds, then it's a Bequest Society recognition. And if the donors cannot change their mind after they make the gift, it's Major Donor AKS recognition. And we are probably all on this call familiar with these levels. Major donor status starts when the lifetime giving of the couple reaches $10,000. Arch Clump Society membership starts when the lifetime giving of the couple reaches $250,000. Our Bequest Society mirrors that same level system, but we simply say when the bequest total that will come to the Rotary Foundation at the death of both partners reaches X dollars, the donor is qualified for these levels. So on the cash side, the major donor recognition, we have to say that this is separate from major gifts. So a major gift that we're talking about today is a single gift of $10,000 or more. That's what we're working on raising for our $1 million dinner. That's all I work with in my job description. However, a donor could become these levels of donors by making small gifts. For instance, if somebody gave $1,000 a year in the Paul Harris Society after 10 years, they're a major donor. Their lifetime giving is now $1,000, but they never actually made a major gift. You see the difference? Major donor, cumulative giving level recognition, major gift, single transaction. So when we're doing our work here, we are not trying to find people to go to this level. For instance, a great fundraising strategy is to find people who might be $3,000 away from becoming a level 1 major donor, and then going to them and saying, Bill, you're $3,000 away from becoming a major donor. Would you please give $3,000 today and become a major donor this year? That's a great fundraising strategy that historically your district has used to great effect. And I support that and salute you for doing that and hope you keep doing it forever. It's great. But it is different from what we are doing here. In our work today and in our work as a committee, we are raising major gifts, single transactions of $10,000 or more, which may or may not result in a level change. For instance, if we have a donor who's already a major donor level 1 at $10,000 and they gave $10,000, they do not become a major donor level 2. They did make a major gift. So we really have two different things completely here. They're a little disconnected, which has the potential to make our work confusing, which is why I'm highlighting that potential for confusion on this slide. So how do we work around that? Well, first, with total transparency, we want to make sure our donor understands what's going on. So the donor doesn't think that they're going to get a crystal if they're not. You know, we want to make sure the donor knows what's happening through good communication. But also, these can be good reasons to set an ask amount. For instance, if you have a donor who's given $10,000, it might be a nice time to ask for 15, because then they would go to level 2, etc. And when we talked about why we might look at a confidential giving history of a donor, subject to the restrictions of how confidential information is handled in session 1, one of the examples we talked about was this particular case, where we might be working with a particular individual, and it's helpful to know how much they've given so that we can know how much to ask for so that they could receive the honor of moving to the next recognition level, because sometimes that's an important consideration and a valid reason for us to have access to the donor's giving history to see that. The Bequest Society gets a little more confusing too, because we view a couple as one giving unit. It can, and it doesn't have to be husband and wife. It can be a couple. They don't have to be married. A Rotary couple, you know, all it takes is 2 people to come to Rotary and say we're a couple. So we don't need to see a marriage certificate or anything like that for people to say we're a couple. We don't need to go down those roads. But when people are a couple, we say at the second to die, what's the total amount Rotary would get? So let's use an example and say that they set up their estate plans so that at the first death, Rotary doesn't receive anything, but at the second death, Rotary gets $25,000. Well, they would be level 2 bequest society members because at second death, Rotary would get $25,000. Maybe they set it up so that at first death, Rotary gets $25,000 and at second death, Rotary gets nothing. Well, still level 2 because at second death, the total amount received $25,000. Or they set it up so that at first death, Rotary gets 50. At second death, Rotary gets another 50. Well, then they're level 4 because at second death, the total amount is 100,000. So we have to be cognizant of that. And again, whatever donors decide is right for them, we're happy to recognize. We don't push one way or the other. Everybody's situation is different, and we are happy to recognize whatever the donors decide are right for them. Now, this also gets a little bit confusing and an opportunity for us, because when we set up our estate plans, we often do it, and are probably best practice to do it, by percentage of our estate. So instead of saying you get $25,000 from this account, let's say you get 5% of this account, which today is $25,000. Well, fast forward 5-10 years. If I've done nothing to change the percentage of that bequest and the account has risen in value, guess what? The value of the bequest has also risen. And so when a donor funds a bequest with that vehicle, which makes a lot of sense for 2 reasons. One is it preserves liquidity, because when an estate is executed, there will always be X%. And number 2 is it preserves value. If I wanted to give the value of a new Chevrolet 30 years ago, I'd have given $6,000 to Rotary. If I want to give the value of a new Chevrolet today, I give $30,000. And so putting in a percent preserves the value as well as liquidity. So I can fund a bequest that way, and then if I want to keep the dollar value, I have to just periodically update, lower the percentage that Rotary gets to keep the dollar value the same. Or if I choose to leave the percent there and leave it to grow so that I keep that value impact I want to have, well then all we have to do is find out from the donor what the current market value is on the bequest and update our records. And that update, that delta, that change counts as a new bequest for the purposes of recognition, because we want to say thank you to the level that we're currently in the estate plans to receive. So in our conversations, we will often run into donors who will say something like, yes, I joined the bequest society, I put Rotary in my estate plans for 1%, and it was $10,000. Well, what's 10% of it today? Well, today it's $50,000. That was a long time ago. We can then consider that a $40,000 new bequest and recognize them as a level 3 bequest society member. Because if they were to die today, we would receive $50,000. They should be recognized for that, because that is even more generous than the $10,000 level they've already been recognized at. And in order for us to do that, we need to book that as an expectancy so that we can more accurately plan and know what's coming down the pike for us. And so we want to stay up to date on those changes. And so in the course of our work, we'll run across that situation. And that's a really easy win-win for us. The donor gets better recognition, Rotary's foundation records are more accurate, and we count the change of the increase to our goal as new funds raised, because Rotary didn't know that was coming until now. So those are ways we say thank you. Each one of these levels comes with wearable recognition, appropriate lapel pins. Some of them come with engraved crystals, and level 1 bequest now comes with a small art piece. The idea here is that when we have the conversation with the donor and they said yes, they want to make the gift, that we ask them, how would you like to be recognized? Rotary offers these opportunities. Would you like them? And sometimes the donors will say, yes, I would. And then we say, what name would you like engraved on your crystal? And we let me know, and we'll make sure the donor gets the crystal. Other times donors say, no, I don't, I don't want the crystal. It's just another thing to dust, or it clashes with my decor or whatever, that's fine too. Sometimes the donors want just a lapel pin. Other times they want the wearable ladies pendant and a lapel pin. kind of the default that I often give to a couple where it's a man and a woman is 2 lapel pins and 1 pendant, because sometimes women's clothes prefer to wear the lapel pin and sometimes the pendant. We want to do what the donor wants. So we want to have these fun conversations so that we give the donors the type of recognition they want. We don't want to give someone something they do not want, just assume they want it. And if they want a resource like a pen or a pendant, we want to make sure they get it. So this is important. The process for these is to send them directly to the donor's home from the manufacturer. It's a company up in Green Bay, Wisconsin. The donor then works with their local district leadership to figure out a time to present them in a way that works well for them and everybody. What I would say is most commonly desired by donors is that the donors would like them presented at their clubs, and then the districts often want to present them at district events. And so I suggest that they get presented both times. There's nothing wrong with saying thank you twice. Present at the donor's club, because that's where the donor associates with Rotary the most. And it inspires other people in the club to give. Well, if Sue could do that, maybe I can too. It makes it less out of touch. Oh, only those people become Bequest Society members. One of my friends who I eat lunch with every Thursday did it. Maybe I can too. And so it has that effect, but also celebrate it at the district if that's part of your custom and culture, because that's a really great way to show how many different people in your district are coming together through our Rotary Foundation. So it doesn't have to be an either or, it certainly can be an and both. And if the donor says, no, I'm very shy, or I don't want people to know, or doesn't even give us a reason, but says, I prefer not to have a ceremony, we honor the donor's request, because it's not about us doing a show, it's about the donor feeling appreciated in the way that really makes them feel appreciated for their generosity. And your district has a rich tradition of thanking and recognizing the donors. I wish every district in our zone had the same heritage around that your district does. We know other ways we say thanks too. Points, we all know about Paul Harris points. Gifts to the annual fund, Polio Plus, or an approved global grant generate them. We know about Paul Harris Fellows. We know about a benefactor. Someone becomes a benefactor anytime they put the Rotary Foundation in their estate plans for any value. So every member of the Bequest Society is automatically a benefactor. Additionally, there is another road to benefactor, completely separate from that, and that has a $1,000 price tag on it. Anyone who gives $1,000 or more to the endowment fund during their life also becomes a benefactor. So the benefactor kind of has 2 different paths to get there. An estate gift of any amount or a cash gift to the endowment of $1,000 or more. And we know about the Paul Harris Society as well. Not what we're working on today, but certainly a source of prospects for us, because if someone loves the foundation's work enough and has the capacity enough to say, I will give $1,000 every year as long as I'm able, we should probably be in a conversation with them about a bequest or about a pledge or about an outright major gift or life income agreement. They might be good candidates for those sorts of gifts too. This is where we will pick up next week with our role playing. We'll be looking, I'm giving you a sneak peek, we will be looking at some case studies of people who might be very similar to the people that we're going to be working with in our work. And we're also going to next week be looking through our list of friends and family and Rotary buddies and fellow neighbors and Rotarians to develop our prospect list and kind of put into practice the principles that we've been looking at this week and the week before. So we're going to end looking at this slide here today. We have a few minutes for questions, and then I'll let Bernie close us out with any housekeeping rules that he might have. But thank you all for your patience and participation. This was the most dense, heavy information side of our 3-week series. Next week will be our interactive side, where we'll be doing a lot of discussion and talking and sharing ideas amongst ourselves. And we'll also come out of next week's session with a finished product, which is a list of donors that we're each going to work with. Bernie, over to you.
Okay. Well, Thank you very much. You know, I must say, when you had your discussion about the Bequest Society and having it, if you will, reevaluate it to see what the amount could be after a period of number of years, that actually for me, I know a number of people years ago that have done bequest societies. It probably, and that's like an easy touch, is to just say, well, maybe we need to just look at that and see if it's changed over time, and it could result in a significant increase in that. So that's, I thought when you were covering that, I thought that's something pretty easy that all of us could do if we only knew those people that did the bequest society a couple of years ago, I guess is what I'm saying. So that was very good. Does anybody, I'm not seeing any chats, but if anybody, so that's good in a way. So if you have a question, just unmute and go ahead and ask the question to Carl. Go ahead, if you have a question.
Bernie,
Yeah.
Bernie, to your point, is there a list there that we can get somewhere of those individuals who have the percentage gift?
Carl?
We can find out who's in the Bequest Society, and we can find out what year they joined. We cannot access whether or not they funded with the percentage or an outright gift. We'd learn that through conversation with these folks. And yes, that is absolutely a great way to look at finding prospects. And as Bernie said, it's really important that we do that because we want to thank those donors. You know, if you have put us in your estate plans for a percentage and you have left it there and allowed it to grow, and now it's worth a higher dollar value, that donor deserves to be recognized at the amount of philanthropic impact they're going to have, and not the level that they used to have. You know, and we really want to make sure our donors are appreciated properly. And also it's good for Rotary to know what we really can legitimately expect so that our reports are accurate when we're looking at planning our future.
It also helps us towards our goal.
Absolutely.
Bob Gross, you have a question?
Yeah, our team is scattered throughout the district, sometimes unevenly. We have several members from the Hilton Head Club, and there are many clubs that are not represented. How do we identify? We can identify members in our own club who might be potential donors, but how do we identify potential donors throughout the whole district? Or is that something that we're going to address next time?
We'll talk about that next time, but the honest answer is we won't, Bob. We will leave people out of this just because you can only scratch so deep. This team was intentionally built to have geographic diversity. We paid attention to many different metrics, and geographic diversity was high on that list, and did the best we can with that. The other thing that complicates this is the travel limitations and meeting limitations due to the coronavirus. If this wasn't in this very unusual time, we would be able to travel more, we would be able to do more events, we would be able to visit people, I would be able to travel and visit people, and we would be able to scratch even deeper through that travel that we're presently unable to do safely. So we will, unfortunately, not get every possible gift giver in your district, but that shouldn't stop us from getting what we can. And so the honest answer is, you're right, there will unfortunately be people who get missed in this. That just means we'll have to do it again later and catch them, but we'll still do a good job. We'll do the best we can, and we'll capture as many as we can. And we kind of take a twofold approach to this effort to generate prospects. One is data-driven approach that I can do. As Paul mentioned, I can run a list of Bequest Society members. And in our Coffee with Carl meeting that we had a few weeks ago, I mentioned how I can tell you have a lot of prospects by looking at those reports. So I can look at who's a level 1 Bequest Society member. They might be a good candidate for moving up. I can look at who's in the Paul Harris Society for a long time but not made a major plan gift. They're good candidates for a conversation. I can look at people who might be $10,000 to $15,000 away from the next major donor recognition level. They're good candidates. We'll find people like that through the reports. The people who we won't find necessarily are the people who are in your clubs who don't meet those definitions. but who are still good prospects, but they just haven't been engaged. And that's where your team will really be the best value add, are your friends or the people who might meet those qualifications, but the only way that they'll actually engage is if their friend talks to them about it. They don't know. And so you being on the team and knowing and connecting with them will help them. And so we will take a twofold approach. Your work will be with your individual friends, your list of 3 to 5 people apiece who you know. And then Bernie and I will take a look at the larger data set. And what we'll do is we'll get all your names, and this is next week's class. We'll get all of your names after you've went through and we've done the case studies. We will then look at our master list of people that the data shows, and we'll make one big list of everybody, the people your names came to the table and the data-driven lists. And then we'll let you all handle the ones that you have on your lists. And then we'll take a more mass approach to trying to reach out to the others. Traditionally, that's meant a letter inviting them to meet with me as I've traveled through. That won't be happening because of the virus. So we're working on other creative ways. And I welcome any ideas you might have, because we're still trying to figure that out, what the best way to engage with those people are in this world where we're not able to physically be present. But we do want to try to reach out to them with the understanding that it will not be all inclusive, and that's okay. It's okay that we don't get everybody. It's okay that we do as much good as we can with the hand we're dealt.
Okay, well, for example, here in Beaufort, we have 3 clubs. Alice is in one, I'm in the other. The third club would be maybe a target-rich environment. So would we can get together, Alice and I would be able to get together and talk about possible people there. Would we get a list from you saying these are people that you might want to talk to? What's the best way to target that group, that third club?
You know, that's a great question. And that might be something we do differently now in the era of coronavirus than we've done in the past. In the past, I would have just said, take the ones you know personally and work with them. And the ones that you don't know personally, we'll take care of other ways. But now that we're working in this new way, we might do that as a way to work. The only thing that I am trying to do a little differently here also is I am, instead of doing individual visits with a lot of people, I'm trying to speak at more clubs who are meeting on Zoom and do presentations about giving to the Rotary Foundation at this time with a major planned gift to their club as their presentation, since we can't travel and a lot of Rotary clubs are having meetings on Zoom. So it's possible we might put doing club presentations on Zoom into our toolbox, which is totally new to us too. Please, everybody, think about those different ideas over this week. And then when we come back together next week and develop our prospect lists, if you've got some ideas about how to reach out to the others, those other prospects that we don't have a personal relationship with so much, we'll figure that out together. That's part of us all working as a team and thinking our best thoughts and putting our best energy forward and being willing to throw the old playbook out the window and, fall back and hunt as best we can.
Carl, we do have a question. Pauline, do you want to unmute and ask your question?
Yeah, well, I think it falls into think about it and get back to him. But I was just wondering, we have a whole group of immediate past presidents coming up. Maybe a coffee with Carl, on Zoom, and maybe they can identify those pockets that were not represented at. I know they would have missed some of the training, but we've got a shorter window, so I want. And then how about what can governors do during their visits? I'm probably gonna have a majority of them via Zoom. Also, I'm gonna have a weekly district club meeting, all clubs, anybody can come. So if their club isn't meeting, they're gonna come there, so you can be a presenter there. I don't know how much you can get in 30 minutes, but or maybe a series, maybe the first we dedicate 1 month and you come every Wednesday at that time, and I don't know. Those are my ideas.
Those are great ideas, Pauline. Thank you. Yeah, that's the kind of solutions we need to find. You know, we need to figure out how to do the best we can, and those are great ideas. Thank you.
Carl, this is Paula.
Hey, Paula.
You've answered, well, actually you and Pauline and Bob have answered. The question I had was, how broadly will this initiative be communicated to the district? And you've come up with a couple of ideas. Is that, so is that broad enough, or
You want it to be
communication different?
Yeah, you want it to be as broad as possible, because one of the worst things that could happen is you get done with it and somebody says, well, I would have given had I known. So you want to make sure everybody knows, or at least no one can legitimately say they didn't know. You know, you at least want it, so you have already, you know, generally we announce these things at our big assemblies and our big banquets, and now those are all gone right now. And so, you know, within your district, you'll want to announce it in all the ways you can. The web page, the newsletters, you know, in your governor's visits. You want people to know about it because you want people to participate if they want to. You don't want anyone to say, well, I wasn't asked, or I wasn't invited, or I didn't know. You know, so definitely you want to spread the word, shout it from the rooftop.
So we can go ahead and we have a communication plan. The Foundation Committee has a communication plan throughout this year, and where we'll be recognizing a particular area of focus each month. So we can add something to that. You have anything already written that might be useful for communication through social media and to our clubs and other forums?
That's a good point about the social media. See, that wasn't even on my radar. That's how out of touch I am with a lot of this stuff. But you're right. You probably do want to share it on your club social media, your district social media. What I can connect you with is Stephen Beer, who is Bernie's counterpart in 7600.
Oh, I know Stephen.
Yeah. And Mike Conrad, who is
Yeah.
Bernie's counterpart up in 7690.
Yes.
Who both did these. Stephen's in the process of doing his, and Mike's wrapped his up. And they can share with you the language that they used in their communications, and that way you can tweak it and make it yours as is appropriate for your setting, but you don't have to reinvent the wheel.
Okay. Great. Thank you. That's helpful.
Please email me that request, and I'll just connect you to Stephen and Mike email.
Sound good to you, Bernie?
Yeah, I was hoping to get through our first 3 training sessions before we really unleash a bunch of stuff at the district level. I wanted to make sure everybody had the opportunity to hear what Carl had to say and kind of digest it.
Mm-hmm.
I also have a complete list of our team members with photos and contact information, and that's going to go out once we finish our training. So that part, I think, hopefully after next week, maybe 2 weeks from now, we'll hopefully put a plan together and get some of this information out and kind of get really kicking on this. This is kind of my thought.
It's an information gathering kind of exercise right now.
Yep.
Okay.
Anybody else with questions? Ann, welcome back.
Thank you.
Anybody else with questions? If not, now wait. We gotta end this thing. Carl, can you, everybody be quiet, stay in place, shelter right where you're at. And I'm just gonna say, thank you everybody for coming. Carl, get ready to hit the stop recording. Okay, you see it? At the bottom of your screen? I probably have it too. I can probably do it.
You have to, mine just says record. I'm not recording it.
Okay, I can stop it. So again, thank you everybody. We will see you all next week, same time, same station. And thank you again for spending the time with us. I'm going to now end the recording, which will be available on YouTube sometime today. Thank you.
Thanks.
Bye-bye, everybody.
Thank you.
Bye-bye.
Thank you.
Bye-bye.
Bye-bye. Bye-bye.
Bye.